Good afternoon, Bill Ulivari here, your investment advisor. It's Sunday, April 6th, and we're going to go through a quick group of charts because I want to show you and share with you my screen to give you an idea of where we are in terms of the stock market and the potential five-year buy signal that we're getting right now. So here we have a weekly chart of the S&P 500. Clearly, you can see that we are still in bull market territory. I mean, other than the COVID decline in 2020, and also, this was the Great Recession in 2008, 2009 down here. But really, since 2012, we have basically been straight up, with the exception of just your typical pullbacks, your typical declines to a trend line. And I think that's what we're experiencing right now. So clearly, take a look at this chart up here. This is not a great depression that everybody's talking about. This is not a great recession that everyone's talking about. And so I just want to make sure that you guys keep a perspective of what's going on because here we saw, the market rally after COVID, and Jerome Powell began raising interest rates from like 0 to 5.25%, and that's where we got this decline here in 2022, and going into 2023. That I would call that a bear market in many respects, but still, once again, it was just a return to our trend line, and I think the same thing is happening here. Speaking of COVID, this market has not been this oversold since January 2020. This is a 10-year chart of overboughtness and oversoldness, and the market is currently 135% oversold. Way too much selling, way too much liquidation, and I think not because of true fact of numbers, but because of anticipation of what could possibly happen. Very emotionally charged market here, and I think this is actually a great time to take advantage of that because again, we were up huge after COVID. Let's try to remember back what that was like. The entire world shut down. There was a global lockdown. They had chains on the doors to shopping malls in your local park districts. If you, it was work from home. I mean, everybody remembers just how bad the global economy shut down. And look what happened. 1 year after COVID, the stock market rallied 52.6%, 96.26% in the Russell 2000, which I call the Main Street. 72% in the technology heavy QQQ NASDAQ, and the S&P 500 1 year later rallied 56%. And again, it had to do with interest rates being lowered by Jerome Powell, and it had to do with the oversoldness of the market and the panic over what was going to happen. The stock market, though, ultimately is driven by earnings. And what we're seeing here is this decline in projected earnings of the S&P 500. That's also part of what's going on with this decline. But you can clearly see that for the second quarter, third and fourth quarter, the rest of this year, earnings are substantially higher than they've been in the last number of years. So I'm very bullish that projected earnings and estimated earnings are still very positive for the market. And here's a quick, interesting chart from our friends at First Trust about the history of stock market corrections going back to 1942 until 2025. So 1942 to present date, the market declines 5% or more about three times a year. But you don't hear that much about it because it happens like over a week and it doesn't make so much news. But the stock market also declines 10% or more, between 10 and 15%, about every 16 months. So every year and a half, the market declines about 10%. And what does that mean? Well, what was 16 months ago? 16 months ago was the fall of 2023, where we traded below our 200-day moving average. We quickly reversed and then began rallying and had an amazing rally all this time period. So I want you to keep in mind that if the market does experience these 10 to 15% declines every 16 months, this is the last one. And look at this market rally that we had following. I think we're going to do the same thing. I think in a matter of days, we're going to have this reversal. We're going to trade back up above our 200-day moving average and probably make a new high, maybe in 6,500 in the S&P 500, which will be an amazing rally. And what I think is going to kind of look like is there was only very few stocks were up on Friday, with the stock market down 2,400 points, the Dow Jones Industrial Average. One of the stocks that was up was Nike. And why was Nike up? Because the trade tariffs that Vietnam has with the United States, which are 97%, they tax us 97% when we export to them. They basically are coming to the table and saying, we surrender. Uncle, and Nike does a lot of manufacturing in Vietnam. So this is really a good thing. We're going to see the smaller, weaker countries that have very high tariff rates against us, and even the mid-sized countries begin negotiating with the current administration about dropping their tariff rates and making things more level. I think that's the negotiating tactic here. This chart is the interest rates, the 10-year U.S. Treasury, which is considered the benchmark for interest rate moves. You can see that again during COVID, Jerome Powell dropped interest rates to almost zero, completely flooded the market with money and liquidity, and then began raising interest rates in 2021, going into 2022. Peak interest rates were around 2023, and they begin to selling off over here. Now we have 10-year rates at 3.95, 3.98. I think we're going to break this 3.8, 3.7 area. And when we do, I think the 10-year rates are going to come down here to the 3%, which is what our target is. So in my opinion, clearly interest rates have peaked and they're headed on their way down slowly, but we're probably going to see six, potentially four more rate cuts this year. So expect interest rates to drop another 1% to about 2.9 to 3% in the 10-year bonds. And that would probably bring mortgage rates closer to 5%. Here's gasoline. Jerome Powell is worried about inflation. Well, he's not seeing it in the energy index because gasoline has gotten absolutely annihilated and crushed in 2025, where gas was around $2 per gallon for reformulated gasoline. Now it's down about 25% to 1.72 per gallon. Here's the 10-week moving average. This is a technical picture of whether the market's overbought or oversold. And you can see here that, again, in 2022 and going into 2023, we are as oversold back then as we were, again, in the end of 2023 and in 2022. Great time periods to buy. And I think that we have to be aware of this opportunity because it's really out there. This is a great indicator, a short-term indicator that gives us an opportunity to get an idea of like how things are looking in terms of their oversoldness or overboughtness. And Scott Bessent, our Treasury Secretary, said, hey, this is not a tariff sell-off. This is a Magnificent Seven sell-off. And he's right. The Magnificent Seven, which are these high-tech stocks that everybody talks about, Apple, Google, Amazon, Nvidia, Facebook, Microsoft, Tesla, those top seven stocks have gotten crushed this year in 2025. They're down 28% compared to our 10% or so in the S&P 500. So again, he's not wrong that this has been a huge sell-off in terms of the stock market and how it's dragged things down. And here's the volatility index. The VIX or volatility index closed on Friday at 45.3. What happens when you get a close that high? Stocks rally 100% of the time over the next 1, 2, 3, 4, and 5 years. And the rate of returns are way higher than normal. Typically, you'd like to think that the S&P 500 rallies about 8% a year, 10% a year. We see, 12% a year. On average, we're going to get a rally of 40% to 60% over the next 1, 2, and 3 years. So even if you're close to retirement, even if you feel like you don't have any more landing strip left, you still have to consider your financial situation, but understand that this market could have an incredible rally over the next 2 to 3 years of not 12%, but 60%. And so that's all I wanted to bring to your attention. If you have any questions or comments, if you have a work 401k that you're not quite sure what to do with and you'd like me to take a look at it, feel free to give me a call. Our number is 847-686-4800. And thank you so much for your continued trust. And again, feel free to give us a call if you need to chat. Have a great day.